TCS has reverted to its usual wage hike cycle for FY22. Employees are going to get wage hikes effective 1st April as always. This comes 6 months after the previous hike in October 20, so it's actually 2 hikes in 6 months. The rising demand for digital talent is probably leading to wage inflation. And will that impact margins, or is this a sign that companies are even more confident of orders? Let's ask Joseph Anantharaju, the Executive Vice Chairman and CEO for Product Engineering Services at Happiest Minds Technologies. Also joining us is Venkat Ramanarayanan, the Managing Director and CFO. Gentlemen, thank you very much for joining us. Mr. Venkat Raman, if I may start with you, what's your sense? Are wage hikes now going to be generalized for the industry? And should we read it as positive that there's so much work to do? Or should we read this as wage inflation?
I think the wage increase is coming back after a year of pause because given the pandemic situation and the huge reset that happened in the industry last year, most companies had resorted to some sort of a pause in their variable pay policy or fixed pay increase and all of those compensation components. But now, given the way the markets are opening up, especially for digital talent, there's going to be a huge expectation increase and as well a rush for talent, or a mad rush for talent, I should say. So given that and the profit improvement that most of us have shown last year, the expectation of a wage hike is imminent, and that's what we are seeing in the market right now. Joseph?
Yeah, and from Happiest Minds standpoint, we've actually advanced our increment cycle by a quarter from July to April, and so we're in the process of doing our PEPs and getting the increments rolled out at the earliest. And we've decided to be a little bit more generous this year. So we're still finalizing the exact number, so I can't share that, but it'll be in the double digits. And we're going to cover the entire company, both right from the junior levels all the way up till the executives. The other thing we've done is, for Q3 and Q4, we have, decided to have 100% variable pay as per, whatever was promised to each of the, cadres. And so we've decided to give people the full variable pay that's in their letters. All this is an indication of, the confidence in the business, as well as, the fact that we recognize there's a demand for talent out there.
Joseph, that will mean a crunch in margins?
So, Venkat, you want to take that, Venkat?
Yeah. Margins, effectively, we have to make up for the cost increase by the expansion in revenues that we are all looking at. The obvious next question is, how is the next year looking? The demand is picking up. Joseph will give us a little bit more of color on that. So when I'm planning for FY22, I'm seeing the improvement in top line and also operating parameters of pricing, utilization staying where they are. We should be able to factor in the wage increase that we are currently talking about. But as I've always been saying over the last 6 months, we should start looking at some increase in SG&A costs, because the pandemic year had really given us a huge amount of credit on many of those cost elements, which are likely to come back, and which is what I have been talking about our financials over the last 6 months, because our EBITDA at about 27.3% for the 9-month period is something which is really high. And I've been not guiding, but saying that we should look at something like 21 to 24% as a consistent EBITDA number, and largely because of, one, the wage increase. Wage increase, we will make it up with volume increase that I talked about, but more importantly, the cost elements of SG&A slowly coming back over the year as the pandemic recedes.
Okay, got that. So wage increases and SG&A costs could perhaps normalize the margins to the 21 to 24% mark. Joseph, I wanted to talk a little bit about hiring, because in Q3 you did mention that because demand has picked up so much, you're hiring on a large scale. When you say large scale, what are the numbers that we're looking at?
So I don't want to share the exact number, but given the first quarter of the year, we had eased back on hiring. We had to really crank that whole engine up in Q3, and I think it took us a little time into maybe early January. So right now we have, across the board, across all BUs and skill sets, using multiple channels, partners, relying a lot on referrals. And, internally also, we've really beefed up and staffed up the talent acquisition team to increase the pace of hiring. And I think it'll be much, much higher than what we did last year. At the same time, we've continued to retain our focus on people. That's the theme of the company, happiness, happiest people, happiest customers. So a lot of engagement, wellness, skill updation so that, we have more mobility across skills is what we are focusing on.
Joseph, time permitting, I'll come back to that. Sure. This is a pre-market hour, so we have to hurry. Deal wins, can you give us some guidance? How much better than you thought, or how much better than FY21?
Yeah, so when, towards the end of Q3, in Q3 we have seen the overall market sentiment improve, and we had seen increase in demand, especially in, 3-4 industries where I think people are a little bit more confident: edutech, media, high tech. And once we came back in January from the holiday season, and I think post, I would say, inauguration, I think there a lot of good news or positive news for the market, right? We had the vaccine rollouts happening, looked quite good. The political environment sort of stabilized. And I think a lot of the industries realized that they need to get on the digital bandwagon. So we've seen manufacturing, industrial, logistics, retail, all of a sudden, increase in the number of deals, and also the size of the deals is increasing because customers, I think, have realized that they really need to, complete their digital transformation initiatives. Earlier, what they planned maybe over 3 years or 4 years, they need to get it done faster if they have to keep pace with competition or get ahead.
Okay. Mr. Narayanan, Europe is about 10% of your overall business. Are you seeing a slowdown there given the increased lockdowns and rising cases?
Europe has been going between about 8 to 11% for us over the last couple of years. It's been an area of focus for us. So while that's not a generic statement of the state of the market in Europe, because that's something that we want to focus, take it up to the 12-13% numbers, it's been largely dictated by the kind of customers we have been able to penetrate there. So I would say it's a well-penetrated, well-served market. Digital transformation or adoption is slightly slower than US. So these are the two factors which are playing as far as Europe is concerned. So while I'm not saying that the growth has slowed down, obviously it's a better penetrated market, and so to that extent our ability to grow is limited by that. But more importantly, that's an area of focus for us in the years to come, Sonia.
Okay. Well, Joseph, can you leave us with just two numbers? One, how much more ballpark may you hire? 20% more, 30% more? And second, since you're a new company, we don't know your normal hikes. What are they? Can you give us a number?
So, if I look back into, FY20, it's the last time we gave a hike, we were around close to 10%,
okay.
So this time we'll obviously be higher than that. We will have to give, higher than that. And also mention that, variable, we're going to give people the full variable, whatever's there in the letter for both Q3, Q4, as well as for next year is what we've already committed to people. And then we'll see, based on overachievement of results, there would be, scope for overachievement in variable as well. And in terms of, hiring, I think the numbers that you're talking about, we should come in that ballpark,
okay.
In terms of increase. Because we're also running at high utilization.
Okay.
And we want to make sure that we normalize for that.
Yeah, I got that. Actually, this was some NASSCOM chap's number, so it's come from the industry. Venkatraman and Joseph, pleasure speaking with you. Maybe we will have more time when we get you post-market. Thanks a lot for joining us.
Thank you.
Thank you very much.
Thanks. Bye-bye.
Deepan, what